it is significant. It not only pulled estimates, it pulled its economic outlook. It's reviewing its capital plan. It tells you the kind of market that we're in and the unknowns that are going forward. The quarter itself, kind of came, you mentioned it missed or it was in line with the street estimates. It missed our estimates a bit. That kind of tells you what is going on with the COVID-19 over in Asia and the impact it had in February at the end of its quarter. It kind of highlighted how quickly it's seeing China rebound, but then the unknowns in Europe and the U.S. and the speed with which everything is happening day by day was really the impact on its outlook.
Yeah, and of course, FedEx, earnings from a company like FedEx are so key at a time like this because you're talking about actual real-time looks at how goods are moving around the world or maybe not moving. It's a look at industrial activity. It's a look at e-commerce and what demand has been like as people do continue to quarantine and essentially stop going out as much. The fact that it said that it's going to continue to cut costs, though, I mean, FedEx has already been retiring and idling quite a number of aircraft. It's been letting quite a number of people go, offering pay packages. You've seen express and ground e-commerce delivery operations starting to be merged as well. How much further can it go in terms of these costs? And given the fact that we're talking about something like transportation logistics, it's very CapEx and capital intensive to begin with. So what does that mean longer term for its competitive edge?
Well, I think there are two things to look at. One is when you go back to the Great Recession and you say, how quickly can they cut costs if we're in a decelerating environment? The company used to talk about a third is semi-variable, variable, and fixed cost, balance between the three. What we learned in the Great Recession is you can't cut costs that fast for a network. You still need to provide service to all those regions. What they're doing, as you mentioned, they're trying to retire old aircraft. But as fast as they plan to do that, and they plan to cut traffic to Asia by 6 to 8%, they actually kept all those planes or back up and running while they were down for post-Lunar New Year. They've actually brought that back as all the belly space to Asia has come out, so the passenger jets have come out, and they're using their aircraft to keep that demand to replenish the inventories as Asia or China specifically, they noted, was up to almost 90% of production levels. So you're seeing post-COVID-19 the return to business. But again, the concern now is the deceleration that you're seeing in the U.S. and European economy, which is really spreading fast.
Yeah, there's a lot of focus right now on this idea of an airline bailout or a relief package and what that could actually look like, upwards of $50 billion. Could this actually include the cargo airlines like FedEx, especially given the fact that it has asked the government for liquidity support?
Yeah, we were a bit surprised on the call last night that was one of the things they mentioned that they were asking for it as well, given typically you're seeing air freight rates spike because all that passenger space has come out. They said they were part of that A4A group that provides service in emergencies to the government, so maybe it was related to government service. But definitely that's a surprise that if they're already asking for funds, that tells you, given their free cash flow is pretty minimal, unlike UPS, which has about $4 billion of annual free cash flow, that they need to make moves if the economy continues to deteriorate for an extended period of time, if they're going to be solely reliant on that capacity.
Yeah. Finally, Ken, I know you cover more than just FedEx. When you look across the freight landscape in general, whether it's the truck carriers, whether it's the railroads, whether it is some of these cargo airlines like FedEx, what is the data telling us right now? And are there places for investors to be positioned, or is it an area to just stay away from?
It's a great question. We do a biweekly truck shipper survey, and our survey had been kind of holding in a 50 to 55 range for kind of the past 6 months, and it really has tailed off, hit the all-time lowest level on Friday. That is a concern on shippers' outlook. The transport stocks have fallen about 28% year to date, more than the S&P, which is down 23%. So you're seeing the impact there. But rail carloads are down mid-single digits or upper single digits, and they've kind of held that level. They have not. So the data has not fallen apart yet on the actual volumes that are moving, but certainly from a truck outlook perspective, and they are the leading of the transports, and transports are viewed as a leading indicator. Where certainly the shippers are definitely very nervous in terms of future demand going forward.